What's up? I'm Dan Fredenberg, and this is another Chance Encounter.
Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon.
I understand that there are power lines that are getting kind of close.
What's up again? This is Dan Fredenberg, and that there is a commercial real estate building.
Today, I'm joined with Craig Markhardt. How are you doing today, Craig?
I'm doing great, Dan. It's a great day. It's sunny over here in Sioux Falls, South Dakota.
All right, beautiful. And I got some extra special great news for you today, Craig. Today, we are joined by my very favorite member of the audience. And why is my favorite audience member here? Well, it's because this is a chance encounter where I interview commercial real estate players. That means deal sponsors. That means passive investors. It means operators. It means construction people. And you may ask, why would you do that? Well, the answer is if you've ever heard of off-market deals, the private ones you're not supposed to talk about, sometimes called 506B deals, then you should know that you need documentation of your prior substantive relationship, or else the SEC will get ants in its pants, and nobody wants that. It's really, really bad. But the benefit to you is you not only learn how to effectively communicate on the subject of commercial real estate deals and the teams that take them down, but you'll also understand how my guest fits into those deals. But before we get too deep into deals, Craig, do you want to say a thing or two about yourself?
Well, so we are Cam Companies is my company, Dan, and we're a real estate investment and development company. And we primarily develop right around here in the Midwest, the upper Midwest. And we hold about 155 doors at the moment, about 200,000 square feet of commercial space. We really like mixed use. And a lot of folks do not really like mixed use, but we're good at it. And I live in a mixed use condominium building and here in downtown Sioux Falls, and I'm well versed in it. And I've been working on this kind of stuff for the past 30 years.
Awesome, awesome. Actually, it was kind of funny. I had another guest yesterday who was talking about it's like, no, don't want mixed use at all. And I had to look at him like, okay, if you don't have any population density, I guess that is, I don't know. I wasn't
Yeah.
really feeling it. But anyway, the first segment that I always do is the five distinct motivations. Before that, I have to say, but wait, check your eight. Craig, I don't know if you can see through the camera and down into the user's device, but down there might be this hideous subscribe button. It's just like, oh, and you just click and it's okay. It's a stupid joke, but whatever. The five distinct motivations. By this point, I've spoken to at least 1,000 different commercial real estate investors, syndicators, and whatnot, and everybody has their own unique why for why they go through with these different deals. But I found that they fit pretty neatly into these five different categories. And the reason why it's very important to know what people's motivations are in this business is because these deals take months to close, they take years to go full cycle. And so we need to know what exactly is going to keep you from throwing in the towel. And the first one of the five is preservation of purchasing power. Now, what's that? Well, some people, they're basically job optional. They don't need to have a W-2. And the reason is because they've got a portfolio of assets and the proceeds from ownership is how they pay the bills. So if you're in that situation, why would you go through the hassle of making another acquisition? Well, there's a couple scenarios that really stand out. One of them is when inflation rears its ugly head. It's going to eat away from the purchasing power of your cash flow. So it's going to be time to make another acquisition. But the other one is when there's distress or an asset crash, so you can buy at a really steep discount. And that is when it's time for them as well. But I am not to this stage of my real estate career yet. So my big motivation is trading time directly for wealth instead of high wage, high salary. My background is in technology, so that puts you squarely in there. Specifically, it's the CRM industry. So I was helping an Ohio firm, for example. That's the first real estate experience I had, but we were emailing between 5 to 7 million emails every single month, and then doing all these different credit card transactions, affiliate promotions, all that kind of fun stuff. But as I was watching my boss making money hand over fist, it was hitting me, well, how can I pivot to where I'm getting rewarded in the form of deployed capital, aka equity, instead of giving half of it away to tax? So that's what I'm up to. But I find that especially youngsters find that a little bit too subtle. It's not really on their radar. What's more important to them is they want to take control of their schedule. And that comes in a couple forms. One is that you hustle like crazy for now, and then you retire early. Or the other one is you just simply work fewer hours per week, or fewer months per year, or fewer weeks per month, something like that. And a lot of people who have this as their main motivation, retiring or scaling back sooner than later, they think that that's secretly everybody's motivation, but I assure you it's not. For example, there are the ambitious types. They just need to see their names on a great big building. They want to buy their entire hometown. They want the biggest yacht in the pier. And so with these guys, even though that's somewhat vilified in some crowds, the fact is these guys are going to be hustling into their 90s, which makes them fantastic pieces of the GP team. And so that's why it shouldn't be vilified at all. And the last group I have here, they similarly will be interested in hustling into their 90s, but instead of making sure that their great grandchildren never have to hold a day job, they've picked a sector of society, or maybe it's the environment or animals or something. They've got some sort of pet project, and they've realized that there's a big financial component to making a big impact, and that's why they're making their acquisitions. So Craig, of those 5 different motivations, what combination of those would you say describes you best?
Well, I'm attempting to fast track to my retirement. I'm probably about 10 years away from that, maybe 12. And what I'd like to do is hand my corporation over to the 30 to 50 employees that we'll have at that time.
I love that. I love that answer. I love that answer. But of course, whenever we talk about the motivations, quite frankly, it's very easy to stay optimistic and positive. And so it's important to bring that down to reality and realize that there are risks involved in every business, and real estate is definitely no exception. But if you've ever been involved in one of these off-market, private, also known as 506B deals, then the securities attorney in the mix should have insisted that everybody fills out this really invasive financial questionnaire. Of course, if there was no securities attorney involved, then you should run. Don't walk away from it. You should run. But the thing that really jumped out to me when I was looking through that questionnaire was the tolerance for risk assessment question. I felt that it didn't serve much utility. It didn't give much actionable information. So I made my own version of the question, which is a fill in the blanks question. There are many popular investment asset classes, but I think blank is too risky. So Craig, it can be inside real estate, it can be outside real estate, doesn't really matter. What's too risky for you?
Dan, I'm going to steal this question from you, by the way. That's a great question. I think that if we were to put the fill in the blank, it would be marijuana dispensaries.
I can understand that. It's I find anything where people think it's like cool or fun or something. There's just so much competition and demand by people who are willing to work for peanuts, right? Or I guess
Well, if you end up having the wrong person sitting on the other side of the table, say AKA City Council, you may not get your license to distribute back, and therefore can't pay the rent to the landlord. So I just stay away from marijuana dispensaries. I've already had some experience with dealing with trying to set one up and construct a building for one of my clients, and it just didn't go well. So after burning up an entire year of our time, we pivoted and had to redevelop in a different way. So we just wasted an entire year's worth of time, which is money in my mind. So I'm going to stay away from marijuana dispensaries. That's my answer.
I love that answer. I love that answer. But the next question, it has to do, originally when I started up these chance encounters, I avoided this particular question, even though it's vitally important. And the reason why I avoided it is because I know that some people in this industry, their job is more of the public relations, the marketing, the front of the company, and they're not the spreadsheet jockeys who are doing deep dives and underwriting the entire deal. But all the same, it doesn't matter if every single metric counts for you because you are an underwriter, or if you're the front of house type of person. There's going to be one or two different metrics that you rely on to distinguish between the qualities of a different acquisition. And for anybody in the audience who's just listening and not watching, I'm going to read them all out. The first one is cash on cash. Next is IRR. Then I got cost per door. Then I got net operating income. Then I have going in cap rate, which really is talking about the difference between the going in cap rate that you're purchasing at versus what is standard for that area in that period of time. Then there's the loan interest rate, especially if you're going to be assuming a loan. Then there's the occupancy, which is the same thing but inverse as the vacancy rate. Then there's the average income where the property is located. Then we have the amortization period of the loan, especially if you're going to be assuming a loan. Then there's the difference between the market versus the in-place rents. Then there's the population growth where the property is located. So you have some baked in appreciation just simply because of that. And then you've got the sponsor record, which is how many deals have gone full cycle, how many are still on the go right now. Then you have waterfall, split, or exit strategy, which is what happens after your capital is returned. And then the last one I have on the list, which this is not an exhaustive list, so you're welcome to add some more. The last one I have here is DSCR, which is debt service coverage ratio, which means how much of the revenue from rent is immediately going out the door just to pay for the loan itself. So Craig, do you want to give a few of your top metrics that you hone in on?
So I hone in on debt service coverage ratio a lot because we have to pay attention as developers what kind of expenses are going to be coming up the pipeline in advance of us getting the property stabilized. So the debt service coverage ratio is very important to me. Plus, we also have to realize that sometimes not all the expenses move at the same rate. And when they don't move at the same rate, sometimes we find ourselves in a guessing game of, okay, interest is going to stay stable. That's great, but the cost of your insurance may go up by 8% one year, 3% the next year, and then 12 or 15% the following year. You have to stay ahead of that because you got to keep that debt service coverage above a 1.20 or a 1.25 in order to be able to meet the bank standards. And so that means that we have to keep our payments versus our income at a stable rate. So we have to increase the income accordingly. So we have to pay attention to that every time that there's an annual review of a lease. And then the other one that I like to look at is the net operating income. Oftentimes you can have a property that doesn't really throw off any cash to send out to the investors, but it does have net operating income. So therefore it is making money. We don't always show that directly to the investor in a payment. So we oftentimes will cherry pick our investors and say, are you in it for monthly cash flow, or are you in it for the long haul where you're just looking to build your wealth? If they're in it for monthly cash flow, there are some properties that don't make any sense for an investor to invest in. And then if they're in it for the long haul, there are different properties that they should invest in because they're the long hold ones that are 10 years or greater that might double or triple their original investment. And that's a great thing for those investors.
I love that answer. I'm just gobbling it up like a delicious subscribe sandwich, which yeah, that's very subtle. But yeah, that's always the reminder to pull out the Dan Does Deals Commercial Core Competency Cube with the 6 different core roles in a commercial real estate deal. And the whole idea is in every episode I go through all 6, and then this is really going to be pivotal for you to be able to effectively communicate on the subject of commercial real estate and understand how my guest fits into those deals. And if you're looking at it and going, wow, I really wish I had one of those, well, the good news is it's free. You go to dandoesdeals.com. There's a great big button. You can click on it and you can download it. And I confess that I committed the cardinal sin of marketing, which is you should always, always, always ask for some sort of contact information in return for your freebie. But I didn't do that because I think it's really that important that nothing stays in your way from printing this out and getting better at this, because I really think that your ability to effectively communicate is going to dictate your success in this industry. So let's get started. First, talking about repositioners, who are acquisitions people. So they're looking at a whole bunch of different deals and they're doing a whole bunch of paperwork. They're underwriting the deal. That's the fancy word. And that means they're doing the math, they're doing projections, figuring out, first of all, is this property even making the amount of money that the seller slash broker claims it is? Because okay, so the repositioner's job is to find that upside by figuring out how the business is run and figuring out how to do it better. Now, one somewhat peculiar side of being a repositioner that every repositioner is stuck in is you have to have a substantial amount of financier relations. Financiers being people who only deal with paper and money, and the owners of the property. They do not deal with residents or tenants or whatever you want to call them or anything like that. And the reason why repositioners have to have a vast network of financiers and do that financier relations piece is because if they can secure a more advantageous loan, that goes straight to the profitability of the property. So that's why it's important to know lots of financiers. But the next place that the repositioner traditionally looks is the operations and say, how can we get those Benjamins to stop going down those toilets? And of course, when it comes to operations, there's more than just unclogging toilets and collecting rent and mowing lawns, possibly even shoveling snow. In my personal situation, between my web-based asset experience, so anything that requires a website or anything like that, I've got that covered. But the bigger one to understand is that in operations and in this industry in general, vacancy is the enemy. And so somebody on the GP team that owns the property is going to have some serious marketing chops, even if you have a third-party property management, because if you've got a bunch of vacancies, somebody has to step in and get those units filled. So that's some of the benefits of having me on a GP team. But of course, there's only so much wiggle room you can find inside operations. So the next place that repositioners generally look is to get a contractor team involved, to do a value add, improve the entire property so that you can charge the next residents more in rent than the previous ones and therefore discover the upside. But of course, you can spend endless amounts of money on contractors, and maybe that'll make contractors very happy. But if you're gold plating the toilets, there's no way that you're going to get a return on investment. And if you're like me, see, I don't know if you know this about me, but I'm from the internet. So that means I need somebody to keep an eye on the operators and the contractors, make sure that they're keeping the schedule, they're not dragging their heels, not using subadequate materials. And so I need locals, boots on the ground, somebody who can be there in an hour or two, because categorically, that's not going to be me. I'd still be stuck at an airport in an hour or two. So I definitely rely on locals as the internet-based guy. But let's do a hypothetical. You're the repositioner now. Let's say you're an engineer or a physician or an attorney or something like that, and you think to yourself, hey, I know how to buy a house. You basically have your down payment and then you borrow the rest. What if my friends and I, we each put in, $100K each, and then we take over that 350 unit apartment complex down the street? Well, you win the repositioner, or you end up going to the financiers and say something along the lines of, hey, I want to buy this property. It's 350 units and tens of millions of dollars. You don't happen to have, I don't know, say tens of millions of dollars you want to lend us, do you? Well, there's one big burning question that the financiers are going to require an answer to, the banks and lenders in general, and I haven't mentioned it yet. And if you're in a mentorship program or you have a guru or something like that, I encourage you to listen very carefully to this next one, because what's going to happen is the financiers are going to ask, who's your sponsor? Who's your key partner? What's that all about? Before you become eligible for a commercial loan, somebody in the fold has to already own a similar asset, because that will prove to the bank that you aren't going to run the business into the ground. Now, on top of that, this KP sponsor, on top of that role, you need a certain amount of liquidity among the GP team, and you also need a balance sheet for collateral that's worth at least the amount of the loan. But if you have all of those pieces, you got yourself a commercial real estate deal. So, Craig, you mentioned that you're the developer side, so that means that you definitely have the contractor side, but you're also like a KP and also a repositioner of some sort. But you're basically repositioning the land instead of the building. But I don't want to put words in your mouth. Which boxes do you feel you check predominantly?
So we check all those boxes. They call it vertically integrated. We have a plumbing company because we have a lot of assets that are 100 years old or older. And they're mixed use. And so we got to keep those up at all times. We also have a maintenance department, and our maintenance manager is actually sitting behind me working on paperwork today. And he goes through and he looks at almost every building that we have in our local community on a daily basis. And then we have a property management company, and so she takes care of making sure the assets are filled and constantly is visiting with the tenants and looking at leases and then telling us what's going on behind the scenes. And then I have strong bank relationships. Some of my relationships are 20 or 30 years old. And that's the most important key asset that I have, Dan, is the relationships with the financial institutions, because they're the ones that are writing me the lender letter for $12,770,000 saying that it's okay to go ahead and build this hotel. And then we also pay close attention to the metrics of all the stuff that's going behind the scenes to make sure that the investor is making money in the end. So we want to get in at a lower cost per door and sell it at a higher cost per door. So there's a lot of risk that is involved in a piece of real estate. So when you're asking folks what's their risk tolerance, oftentimes a single piece of real estate has different risk tolerances or different risks depending on where it's at in the development stage. Like, we're just beginning to get ready to break ground on a 114 room hotel. The largest component of risk has passed. We have spent nearly $1 million getting ready for this, and all of that money is non-refundable. And therefore, if we decide not to go through with it, our company is out 7 figures. If we decide to go through with it, then we can get that paid back eventually. And so therefore, the biggest risk is actually behind us. So a lot of the folks that we get to work with will come in after the biggest risk is taken, which is wonderful in their mind.
I love that answer. I love that answer. So that brings me to the buy box, and it will probably apply a little bit less to you, or maybe you can give some details about the land. But in general, when real estate people, especially if they're dealing with existing buildings instead of ones that are coming from the ground up, when we say, hey, what's your buy box? What's your ideal property? What's easier to say yes to? We're really asking about 3 main things. First one's geography. Where is it? Which state, which county, which neighborhood even. It's all going to matter before you call it ideal. And then the second one's going to be size. And most of my guests on this show are in multifamily. And in multifamily, the way you define a property size is by the number of apartment units. And that's, of course, important because you're mitigating a little bit of risk because you're not depending on a single tenant, you're depending on multiple tenants. And so a single vacancy isn't going to hit the bottom line anywhere near as hard as when you're relying on one source of income. But the reason why it's important to know the size of the deal is because the type of group that's going to be taking over 10 or 15 unit apartment complexes is going to be fundamentally different from the ones that are 150, 350. And of course, hotels and that sort of hospitality is going to be similar. But there's some types of commercial real estate that go off of square footage instead. But that size is going to matter. The third one, though, I call it desirability. The more common term is class. And I don't like the word class because, well, it's singular and it's 2 different things. And those 2 different things are the condition and then the area. And if you're talking about the condition, you're talking about how old is the facility on the property, how the building itself. And then, of course, is it, really no frills? Is it beat up? Is it full of luxuries and amenities? That's the condition. But if you're talking about the area, if it's multifamily, then the school districts where the property is located are going to be very, very important. But every type of real estate, the crime rate where the property is located is going to be very relevant. And then the last one, there's that old trope that brokers like to say of location, location, location in real estate. But I don't think that's a very informative saying. I believe it's closer to traffic, traffic, traffic. If more people are passing by a given property every single day, it's going to have higher desirability. But both the area and the condition are ranked the same way as in grade school, where you have A plus at the top, and then A, and then A minus, and then B plus, and so on. So, Craig, you can fill in the blanks as far as what's specific. You mentioned Sioux Falls specifically, but what's easier to say yes to?
It's easier for me to say yes to a B class because I can move it up to an A class if I have the right plan and design. And when you move it up to A class, oftentimes you'll spend 50 cents to make a whole dollar behind the scenes. So in addition to the appreciation that naturally occurs due to just how America works. And so I can force that appreciation, and I like that. I like that B class moving into A class.
And then as far as size, it sounds like, you want like a seven-figure acquisition with an eight-figure value at the end, somewhere in that neck of the woods. Does that sound about
You
right?
know, that's ideal. Yep, we have an $85 million project that we're just getting ready to break ground on as well in about 60 days or 90 days. And that's a seven-story mixed use, and it's going to have 200 apartments. So that's going to be our largest one that we've ever done.
I love it. I love it. So then let's talk for a moment about people. And I think the best part about commercial real estate is because it's multifaceted, you got these different roles, and nobody's going to be all six roles personally by themselves. If you're vertically integrated, you'll have those in house. But even though we're all eager to give new referrals, build new teams, even if we're not on them, because of our own unique skill sets, we're better off helping some people than others as far as the benefit we can offer. Me personally, traditionally, it's always been the sponsors and KPs that I'm most eager to meet, just partly because I'm from the internet, but also because of the marketing and content and web assets. These guys, they already have a foundation established so that a person like me can make a disproportionately large difference. Whereas when you're first starting out as a local or a repositioner, you need grunts who can put in 80 to 120 hours a week. And that's just not where I'm at my most effective. So, Craig, I imagine, everybody's always eager to find more financiers. If you have any 506B deals, don't go mentioning those in the same sentence as needing an investor. But who on the die are you most eager to run into?
So right now we are actively engaged in building our investor database and our investor pipeline. So I'm looking for those folks that want to invest 50,000 or 100,000 or even more in some of our projects. We have $235 million worth of development teed up, and it's going to take a significant amount of capital. So we've got a phenomenal LP plan out there with sometimes bonus units. And so we're really generous when it comes to working with limited partners.
All right, excellent. That's really, really good news. So the next question then has to be how to reach out. And me, I'm fairly fortunate because of like being on the internet. I've got this distinct last name. It makes me really, really easy to find, especially on LinkedIn, which is the social media platform where I spend most of my time. But of course, I've got some books for sale on Amazon if you want to check that out. But the bigger one is if you have your phone handy, you can scan this QR code. That goes to the FAQs page of 506B Me, which is the platform that I offer. It's really intended to remove plausible deniability, but at the end of the day, it's to help with the IT to document your substantive relationships for these different 506B syndications and also 506C, just basically prove that you actually knew people. And the idea being is that if your laptop falls in the bathtub, the SEC is not really going to accept that as the reason why you don't have that documentation that's required, and they might accuse you of public solicitation, and that's not so good. But Craig, if people want to reach out to you, social media, email, phone, website, what are the best ways to reach out?
Well, one of the easiest ways to reach out to me is through our website. That's camcompanies.com. That's CAM companies, plural.com. And then also, I've got a pretty robust LinkedIn presence as well. And of course, it's LinkedIn/Craig Markhardt. And then I've got a social media presence on Facebook as well. And our contact phone number is 605, area code 605 376 7468. That's my personal cell phone number. And so when I see somebody come in through the phone like that, then I know that they've actually listened to your presentation here, Dan.
Exactly. I love it. I love it. And that leaves me with one other thing, and it's actually not for you, Craig. It's for you in the audience. It's the public service announcement that I always do. If you've been watching this episode and experiencing searing pains in your eyeballs and like migraine like symptoms, I attribute it to the downright hideous subscribe button that's just down there, and you can get rid of it for free. You just click on the thing. And full disclosure, I want people to click on it because if enough people do, then YouTube will actually start to pay for these videos instead of me. And I think that would be amazing. The trade-off to you, just so we're totally clear, is my videos may show up on your list of suggestions, but you can feel free to ignore those suggestions because quite frankly, I just appreciate the fact that you spent this time with me. Just like Craig, I appreciate you joining me. This has been great.
It has been great, Dan. It was great to get to know you over there in Phoenix as well. So
Absolutely. Absolutely. Thanks a lot. Awesome. Hey there. Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506B or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye. Make sure you 506B me. Any syndicators, make sure you 506B me.
Hi.
Oh, hey, yeah, here's my code. You got your QR code scanner? Okay, yeah, oh yeah, just hold it right in the square there. Okay, cool. And now you hit open in browser.
Okay.
Okay. Are you already logged into 506BME?
Yes.
Yeah, okay, cool. Yeah, so there's my video. So now I'm already on your watch list. So when you get back to your hotel, you can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah.
Nice meeting you.
You too.
506BME, everybody.